And we're recording.
Jason, we got a special episode today. So our friends Michael Batnick and Ben Carlson hit over 10 million downloads this week for their podcast, Animal Spirits, an overnight success that only took them 4 or 5 years. But 10 million is a mind-blowing number. And so we thought to honor their success, we would do an episode in their style, but way shittier.
Oh, is that our MO? We'll copy what everybody else does, but way shittier.
Yes.
Shout out to Ben and Michael. We appreciate all their work. We enjoy it. So I'm going to start off with maybe the first question. And as our resident crypto expert and NFT expert, or as I say, crypto guru, that's what I say. You know, if you've got a question about crypto, you call Corey Hofstein. That's your first call. There's a lot of, obviously the El Salvador thing kind of came to fruition. And there's also a great article by our good buddy, Dave Nadig. Thoughts?
In other words, like, did you read the questions that I was going to ask you? Those are my thoughts, because it's literally what I said I was going to ask you about.
Oh, I thought you want me to go the opposite.
So, I mean, if you want me to talk to you about the questions I was going to ask you, I'm more than happy to.
This is why,
as I said, animal spirits, but shittier.
Okay, I'll ask a different question. You know, we're putting on this total portfolio solution, and it dawned on me that, like, you're looking at different asset classes and they all seem to be at near all-time highs, right? If you're buying stocks at all-time highs, bonds at all-time highs, commodity trend advisors at all-time highs, crypto at all-time highs, like, it makes you obviously nervous putting even together a total portfolio solution. What are your thoughts on, like, almost all asset classes being at all-time highs?
It is pretty wild, right? And maybe just speaks to the fact that there is a flood of money that has gone into the system that's just wherever it's going, it's increasing valuations across the board. I mean, we look at bonds seem to be at all-time highs, but I think what we need to start to disintermediate is when something's at an all-time high from a price perspective versus a valuation perspective, right? And I think all too often we look at price all-time highs and get a little nervous, when in reality, the question should really be, how far has price over or potentially undershot valuations, or is it perfectly in line? I think, again, when we're trying to build those all-weather solutions, the way you've really been focused on, you can't really just look at all these commodities are at all-time highs and prices and of everything else is at an all-time high, because it's not really price that you're buying when you buy this stuff. Yeah, price is what you pay, but for something like a financial asset, what you care about is the cash flow. What you care about is the diversification benefits. And so long as those are still reasonable, I think you can buy prices at all-time highs. That shouldn't really matter what the price is necessarily.
No, you nailed it. That was what gave me solace, is that over time, it's always going to be an all-time high of prices, right? Like, that's just the arrow of time, inflation, more money in the system, whatever you want to call it. Like, just looking at price doesn't give you a good metric for necessarily worrying about it. Even though prices at all-time highs still makes you nervous, but it isn't as worrisome as one would think.
Yeah, there was a study by our friend Jake Econompic on Twitter, and I know our friend Meb Faber did a follow-on study on this that showed that buying stocks at all-time highs was actually a great investment strategy in the US. So again, like, price is something that can scare you off, but if the fundamentals support the price, I'd rather buy at an all-time high if it's a cheap valuation than an all-time low if it's an expensive valuation.
Well, yeah, and we both have an affinity for both value and trend following. So, buy high, sell higher.
Exactly. So speaking of buying high, sort of got the exact opposite situation yesterday. So we're recording on Wednesday, September 8th. On Tuesday, September 7th, there was a pretty dramatic flash crash in crypto. And I actually think it was like Bitcoin Day, where it's like all about stacking Satoshis, where people are supposed to buy a certain amount of Bitcoin on September 7th. And what we also had simultaneously was El Salvador making Bitcoin legal tender, and the president of El Salvador tweeting that they were buying Bitcoin. And actually doing so at a discount because the market had sold off so dramatically intraday. Eventually, his final tweet said they had accumulated 550 Bitcoin, which at $50,000 is the equivalent of, drumroll please, $27.5 million. Thoughts?
One, just makes me think about a company's treasury at $27 million. But I was also thinking about
I think that's less than Michael Saylor has.
Exactly, way less. And so like I was thinking about the crash that you alluded to first. It was like we were talking about yesterday. I went and ordered a coffee, and by the time I came back, Bitcoin had just tanked like 20%. And as I said, you are the crypto expert, the crypto guru. So I texted you. I was like, "Did you just tank the crypto markets?" And you're like, "What happened?" I just went to the bathroom. So
you can't blink and you miss it.
Yeah, I mean, you get that volatility cuts both ways. You know, we love it when prices are running higher, but it's difficult on the other side. I don't want to get into necessarily El Salvador, you know, as far as a Central American, you know, emerging economy, for lack of a better term. You know, is it smart, or does it behoove them to use crypto, you know, currencies? But do you think this is a form of canary in the coal mine? Do you think more countries are going to adopt this, or do you think this is a one-off event?
I don't know. This doesn't tie directly, but one of the other trends that you and I have talked about is the idea of third world countries, particularly those with unstable economic regimes or monetary regimes, using some form of digital currency to create stability. So as an example, in the mid 2000s, there was a massively multiplayer online RPG called RuneScape. And it turns out about 50% of the players were from Venezuela. And one of the reasons that was the case was because, first, the game was not one of these AAA, gorgeous, beautiful, need a maxed out machine to play. You could play it on very old computing hardware. B, you could go online and use your man hours to farm items in game and sell them for in-game gold. And that in-game gold held a price stability to the US dollar far better than Venezuela's currency. And then there was a black market that you could then convert that in-game gold to US dollars. We saw it during the COVID crisis with this game called Axie's Infinity. That's a new crypto game where people are this whole play to earn mentality, that in the Philippines during COVID, lots of businesses were shut down. People were using their cell phones to play this game, earn in-game tokens that they could then transfer into USDC or a US stable coin or Ethereum or Bitcoin. And so there is this really a couple of these examples, at least from the ground up level, sort of bottom up, of people within an economy using digital currencies, whether in game or actual cryptocurrency, to create economic stability for themselves. You know, how it will work from a top down governance perspective, I don't know, but I think it's an interesting experiment. I'm glad I don't have to be part of the experiment, but I think people try to find a way to find financial stability however they can. And cryptocurrency markets may actually, for all their volatility, be more stable than some economic regimes.
It's interesting. Like there's a terrible history with the U.S. CIA and pegging to the U.S. dollar in Central America. So we'll see if it changes anything by maybe having this pegged to Bitcoin, or, you know, essentially maybe a call option on Bitcoin, as, you know, lack of better options for them. So that's always fascinating. The other one, I was thinking about, you know, we were talking about the buying everything at all-time highs and prices. You came out with a great paper this week with the boys at Resolve about return stacking. First of all, how do you work well with others when you're writing a paper?
I don't. I'm not a great team player. I'm a worse boss. No, it was the first time I've actually done a cross-firm paper like this. I have a ton of respect for the team at Resolve. Have collaborated with them on a number of other projects, but never actually written a paper with them. And this was really the first time I've gone outside my firm to write a paper with other people. And it was a great experience. I mean, I think what was hard at the beginning was different writing styles, very choppy. I'd write a section, Rodrigo would write a section, Adam would come in and edit, and it just didn't flow. But, you know, you go through 12, 13, 14 rounds of edits. You pass it around your firm, you pass it around their firm, you get outside perspectives from both your networks. And I think you end up with a better piece, a lot of really valuable feedback and ideas coming from them that we wouldn't have had if we wrote the piece alone. And I hope they feel the same. So a different way of working, but I think there's a tremendous amount of benefit from getting someone else's perspective on a topic.
Give me the elevator pitch on what return stacking is.
Elevator pitch is that we're ostensibly in an environment of low forward expected returns. Now, people have been saying this for the last 7 years, and it hasn't been true. But when you look at equity valuations, when you looked at fixed income valuations in particular, you can pretty clearly say that we should not continue to see high expected returns in either asset class, but definitely bonds in particular. So the question becomes, how do you manage to reach for higher expected returns if you need them without necessarily stretching for assets with maybe greater left skew? So assets with more default risk, higher yielding assets, or just adding more pro-cyclical assets. One of the things we've seen a lot of our advisor community do is try to introduce alternatives. But what occurs when you start to try to introduce alternatives is either those alternatives don't have enough volatility to make them interesting. So you end up having to sell very safe and easy to understand bonds for long short equity or managed futures, and that creates a tracking error problem. What return stacking is all about is the thoughtful use of leverage and saying, if you want a 60-40 portfolio and you want to introduce some absolute return diversifiers, instead of selling some of your stocks and bonds to slot those diversifiers in, can we use leverage, products that provide you capital efficiency and manage the leverage for you, to build a 60-40 portfolio with, say, only 2/3 of your capital, and use that remaining 1/3 of your capital to allocate towards absolute return alternatives that hopefully in 9 out of 10 years are going to be additive to the portfolio return. So we think it's an incredibly powerful concept, something that many firms have been doing for a long time, right? Using leverage and borrowing to buy higher returning assets is something that Warren Buffett used to build his wealth, that he used the insurance float at Berkshire. This is the core concept underlying a lot of the alpha that was generated by Bill Gross at PIMCO. It was largely unavailable to most investors because these types of leverage strategies haven't existed in the past. There's probably about a dozen funds and ETFs that now make this possible for advisors and individuals. And so we wanted to put the idea forward that these portfolios could now be constructed.
As you know, internally, we're huge fans of using capital efficiency. That's another way to say return stacking is capital efficiency. And we use the futures and options market to be able to do that. But as you alluded to, you can create a much more robust portfolio if you're using uncorrelated or negatively correlated asset classes and using some prudent leverage. But I just said the keyword leverage, right? That usually makes people run for the hills. So what you guys are talking about in the return stacking paper, I would say, is on the forefront of where we may be moving with ETFs or other Act 40 funds. But as soon as you say leverage, this is why we say things like capital efficiency, return stacking, people, they're scared of that idea of leverage. Like most people probably be shocked to hear you say that, like you said, that Buffett used leverage. I think on average it was like 1.6x leverage, over 60% leverage. And so it's like, how do you get over that hurdle, or is that signal an opportunity? Because obviously not everybody's willing to do it.
Well, beyond that, if you buy public equities, you're buying levered assets.
Exactly.
Right? Companies borrow to fuel their growth. When you buy equities, they're levered. I think the question is about the recourse of that leverage, right? And is over levering a way to invite disaster? And I think if you do it with pro-cyclical assets, absolutely. If you told me I'm going to take $1 and lever it up to buy $2 of equities, I would say that's probably not as prudent as taking $1 and levering it up to buying a mix of equities and bonds, right? That if you can use diversifying assets versus just levering up a pro-cyclical asset or highly correlated assets, you're getting a very, very different return stream. On top of that, I think one of the things you can do is lever up and then spend some of that excess return, expected return that you're going to generate, and use it to buy tail hedging. And so that combination of capital efficiency plus convexity, I think is particularly powerful. We talk a little bit about that in the paper. We don't explicitly model it, but I think as individuals are looking at the different sort of opportunities out there, I think that's a really potent combination.
You know, to change tactic really quick. One, by the way, when you said pro-cyclical, all I could think of was pro-cyclist, and I was thinking about you riding a bike and juicing it up. But part of I'm joking with you about being the NFT and crypto king and the crypto guru, but there's a lot of learning that goes on in that space, and that's what the fun part is to constantly be curious and learn. And so shout out to Augustin LeBron on Twitter, which is absolutely great. And forgive me if it's Augustine or Augustin, I'm not sure, but phenomenal Twitter follow if you get the chance. But he had a tweet thread recently about learning as we get older, right? And we become so calcified or ossified, and we don't learn new things. We say things like, "Oh, it's stupid," or "It's not for me," and then next thing you know, the times have flown right past you. And so that's part of what you and I have been talking about privately, is the idea that whether it's crypto or NFTs, you've been just learning a ton. We both learn, we both share information, and we're just excited to learn new things, whether they're fruitful or not. Who cares? We're at least keeping some, hopefully, keeping our brains working. And part of that is maybe NFT rug pulls. So maybe you can define even what a rug pull is for people that may not even know.
Yeah, that was, by the way, a phenomenal thread, exploitation versus exploration. I do want to get into that a little bit more, but thank you for the segue into NFT rug pull. So a rug pull is basically crypto phrase for this was a scam. You bought into something and the developers ended up just running away with all the money. Everything you invested gets lost. Rug pull gets thrown around a lot. I think its true intention is like truly the developers or whoever's running the project is scamming you out of all your money. Sometimes it'll get used for when something horrible goes awry or there's a hack in the system and you got rug pulled. But I think the original intention is that it's explicitly intentional by the developers to scam you. There's actually, I don't know, maybe it was a week ago, I tweeted something saying, when are we going to start seeing NFT rug pulls? Right? What is an NFT rug pull? What's that going to look like? Well, as NFTs got really popular over the last month or so, I think the scrutiny for the interaction with smart contracts went way down, right? So for people who aren't used to this idea of NFTs and what smart contracts are, think of there as just being a website out there that I can go and say, when this project launches, I'm going to click a button, pay a fee, and I'm going to mint this picture. And then once all the pictures are minted, that's when they start trading on a secondary market like OpenSea. But the original way often they come to market is through that interface. And behind that interface is a computer program, a smart contract running on the Ethereum blockchain. So what would a rug pull look like? Well, a rug pull might be that the smart contract is actually bugged in some way, that they are somehow getting access to your wallet and sucking out funds. The smart contract might not give you what you think you're getting out of it, right? And so people aren't really looking at what these smart contracts are doing. The other important piece to understand here is that NFTs in and of themselves are tokens that have metadata. And that's what you own. And that metadata often has like a pointer to what the image is, which is hosted sometimes on a distributed file system like IPFS or Arweave, which in theory should be distributed and that can't be changed. But what you find in the contracts is sometimes that URL where the image is supposed to live can be changed, or it's being hosted in some place that is not decentralized, maybe an Amazon web server, and the person who owns that could actually go in and just take all the images down, or they could go in and change the images. And so this actually happened, I think it was yesterday or 2 days ago. There was an NFT project called the Raccoon Secret Society. And they sent out these set of tweets, and I'll read them to you. It said, "The NFT community is sick. All this time, we were working on this project with just one goal, to show people that what they're actually buying when they click that mint button. All raccoons are now dead, and you, the quote NFT community, were the ones who killed them. All these smart contracts that are being copy pasted by developers contain the same vulnerability. The owners of the contract have too much power. Specifically, the function setBaseURI allows the owner to remove all the metadata, the art, at any time. In a day or so, OpenSea, which is where a lot of these trade on the secondary market, will update the metadata from the contract, and all raccoons will turn into a pile of bones. No metadata, no rarity, no art. Only meaningless records on the blockchain. What do you think?
Rug pull.
It's like performance art.
Yeah, exactly. It's like Banksy shredding the picture, right? It's like a Jejun environment. I also was thinking about, you said raccoons and raccoon, like your pronunciation was throwing me off, your Northeast pronunciation. I just like to call them trash pandas myself, but yeah.
Well, that's actually another project. There's a Trash Pandas project. So this one was the Secret Raccoon Society.
But it is an interesting way. It wasn't just your traditional rug pull or scam. I always think it's funny that we call a scam a rug pull like it's something comical when it's really a scam, right? Is that it was also to kind of like have a teaching moment too, which you could argue for or against. I'm just curious of what you thought. Like, does it make people recognize that there's a problem here, or do people still go YOLOing into NFTs?
I think this happens with any speculative bubble, but when you're talking about, people sort of just get caught up and they go, I got to be first in line to mint because I can get a quick flip on the secondary market for a 5 or 10 bagger. And that's what you were seeing with a lot of these projects mid-August. If you could get in on that mint, you were pretty much guaranteed to make money. But that invites a lot of scammers, right? And so I think, like any sort of mania, that's just bound to happen. And I do think it's good. I think NFTs were a way for a lot of people who weren't involved in the crypto space to get involved, because now they got a pretty picture with it rather than just a token in their MetaMask wallet. So maybe it was an important lesson to learn, but I don't know if I appreciate the high and mighty tone of it.
Before we got on here, you and I, as always, we talk about actually the business of running funds and everything. And so this week last week, there was a phenomenal podcast by Meb Faber where he had the guys from Alpha Architects on, Wes and Pat, and they talked about creating ETFs, right? Like Alpha Architects does a white label service for helping people create ETFs, but they went through all the details and costs of creating an ETF and like how difficult it is to create an Act 40 fund. And it's just, quite frankly, they're just brushing the surface in an hour and a half. So I'm just curious, like, this is always ongoing conversations behind the scenes. And I'm glad it puts it out there, because everybody says they want to start an ETF, but unless you got a way to get to 50 or 100 million quickly, you're going to be running at a negative cash flow for 3 to 5 years.
I don't think people realize the costs associated with running 40 Act vehicles, open end or closed end. A mutual fund, an ETF, a closed end fund. There are incredible regulatory burdens that you have to meet, accounting, legal, distribution costs, platform costs. Just getting the thing out the door can be hundreds of thousands of dollars before you even start to get that ongoing run rate. And so I appreciate their transparency into the space. And I know what's amazing is Wes has worked incredibly hard to get the costs as low as possible, right? He's a boutique operator, but Wes is the type of guy who, I'm sure uses his toothbrush for a year straight because he's not about to go buy a new one. I mean, he is cutting it to the bone in terms of cost, not in quality, but just in terms of making sure he can get the cost as low as possible to compete with anyone out there. And it is still very, very expensive from a startup and ongoing basis. And it's one of the reasons why a lot of boutiques struggle to compete in this environment, because you can't get your fund down as low as 2 basis points like Vanguard has theirs, or 5 basis points. Launching a 20 basis point fund and not getting to hundreds of millions of dollars will put you out of business. And so to compete in this low fee environment, it just puts that fund hurdle rate higher and higher. So it's difficult to compete in, for sure. I mean, you just launched a fund on a private fund, but all those costs as well. I mean, from your perspective, any cheaper on the private side?
Not really. And my favorite piece was saying, you need to have 3 to 5 years of run rate And I think that's an accurate way for people to just look at any business in life, right? It's going to take you somewhere between 3 and 10 years
Yeah.
to hit like positive cash flow or to do well in general. It did make me think
And
of,
by the way, and cross your fingers that the
yeah,
market cooperates with whatever style. You launch a value fund 5 years ago as a boutique, you're probably going out of business right now.
right. So you have to have the run rate, you got to have the human capital power, you got to have a target audience that's already dying to buy your product, and then you need some luck, is what you're saying. Timing, you need some timing luck, and
They
that's
need a lot of timing luck.
yeah. And I think about speaking of Act 40 funds and the SEC, I don't think we really want to touch it too much, but there was a great tweet thread by Brian Armstrong from Coinbase about Coinbase trying to just lend, on their crypto wallets. And I think it was like 24-part tweet thread about trying to deal with the SEC and trying to bring this, product to market. And so that would give people a hint of kind of like what you're dealing with in the regulatory burden way, but also how the gray area of the regulatory burden. And I'm not sure you want to, you had no comment on this one?
Well, I'll just say every story has two sides.
Yeah.
Brian was very public with his side. So for those who don't know, right, Coinbase is trying to have a lending offering, much like other crypto platforms. They were shut down by the SEC, and it looks like, and I didn't get my facts straight, but it looks like they might receive actually a Wells notice. I might be wrong on that, but
it was a Wells notice.
Yeah. So that's again, doesn't necessarily mean they've done something wrong, but it's not normally what you want to see. That said, Brian said, I'm not sure why lending is a security, and all I can say is, have you never heard of bonds? So I don't know, but I do want to stay in the crypto space. Okay. So our friend David Deeg, who is I think a brilliant author, doesn't get enough play outside of the ETF space. He just has this unbelievable ability to take incredibly complex topics and distill them into very readable and coherent thoughts. And he wrote something last week about, the Bored Ape Yacht Club and NFTs and crypto in general. But I want to hone in on this idea about what he sort of calls like the trapped money thesis of crypto. Like, why are we getting this bubble wealth phenomenon? So I want to read this section of the article. And it says, in the real economy, value naturally expands through work and money naturally expands through banking. If I'm a farmer and I take my labor to grow carrots and you buy my carrots for $1, I have $1 and you have a socially agreed upon dollar's worth of carrots. If you now sell those carrots again for, say, $2 because you did the work of driving to my farm, then I have $1, you have $2, and someone has a socially agreed upon $2 of carrots. How much money's in the system? No new dollars were printed, but the system has $5 in value, whereas before it had 3. And he says, this is precisely what's happening in the crypto ecosystem. I buy $1 of Ethereum, and then I buy an NFT for $1. I have an NFT worth for $1 based on social convention, and you own $1 of ETH that I paid you. But when we read about the value trapped in the ecosystem, $2 is sort of what gets registered, even though only $1 went in. Now, I think the key difference here is once those carrots get consumed, right, all of a sudden you're back down to the $3 that was in the system. We're not seeing the consumption or the tie to fundamental value in the ecosystem, because so much of it is still vaporware. And I don't mean that in a negative sense. I just mean the projects aren't useful for anything today. They're fascinating and interesting, and it's money Legos left and right, but there's no real economic value being registered right now. So how much of the crypto system is just this bubble wealth phenomenon where it's like sort of like fractional banking on steroids?
So how much of it is a circle jerk? I just think it combines a lot of things we've been talking about, right? Is like you and I talk about this, is like Dave's right? A lot of it's just this circular money flow, right? Or it just flows moving around within the same system. But then we talked about earlier, is like, yeah, but it still behooves you to learn about these new products and new technologies, because you don't know what the future is going to hold. Is there going to be a way for them to break out and create product market fit? Will there be new technologies that we need in the future? And so, you can actually hold this dichotomy in your mind, right? You and I talk about this often. It's like, yes, it's rehypothecation or circular flows, and there's rug pulls, and like all of it may be a scam, but there's a way to participate, learn, and the best way to learn maybe is putting your money where your mouth is, and so it can be both at the same time, and then the future can dynamically diverge from the present. Is that like a fair summary of the way you rectify it in your brain, or is it different?
Yeah, I mean, I think I try to hold multiple ideas in my brain, which is this is a world changing technology and I need to learn it if I want to stay relevant. This is all bubble wealth, and I just need to outrun this ever moving ball of money that's getting bigger and bigger and bigger, and be cognizant that I need to keep bringing money back into fiat as I make money here,
How dare
because
you, sir?
this could collapse at any moment, and it. But similarly, it can go exponential because it's just money being built on money, and none of it really exists, and none of it's coming out of the system either. It's just all sort of socially agreed upon. It's there, but because you can't really borrow against it from a fiat perspective, it never really gets consumed or burnt in a meaningful way, and it's not going anywhere. As long as everyone agrees the money's there, it sort of is. So long story short, I try to stay open to it, but stay risk managed at the same time, which, okay, ties nicely back to exploitation versus exploration, which was a topic you were going to bring up. This Augustin LeBron Twitter thread that I thought was phenomenal, all about as you get older, right, getting more calcified in your thinking. I certainly am struggling with it myself. I feel like as I get older, I'm less energetic and less creative. I like to think I'm wiser. I think I'm probably just more of a wise ass. But you do see it, and I have seen it in the last month. The more I talk about NFTs on my timeline in Twitter, the more people are pushing back on me, and especially in traditional finance, and they sort of think I've lost my mind. Maybe I have, but I am trying to stay open to these things. I'm curious as to your take as you get older, this sort of exploitation versus exploration trade-off.
Yeah, I try to. It is a trade-off. I'm not sure how I manage it, and I'm much, much, much older than you, but I'm definitely losing energy, but I think increasing in creativity, because the way I look at it, exploration versus exploitation, it goes back to this idea that we have an adaptive unconscious, and so if I have any sort of free will with consciousness, I can try to put as much stuff, as much information into this brain as possible, and then allow my subconscious to marinate on and come up with creativity. So I've always looked at life that way. Is like I need to feed this creative mechanism with as much information from disparate parts of the world as possible. And so it's just the way I've always operated. And then, versus consumption versus exploitation of then what do you do with that information? That's always a tough trade-off. But I think we're naturally inclined to build things. So you go, okay, this is great. I've got all this information, but now what do I do with it? How do I make this a viable product or something like that? But I think I actually over index on exploration. And everybody always says, you should be a producer, not a consumer. And I've never agreed with that, because I probably consume 10 times as much information as we produce. And you and I don't have necessarily a problem producing, right? We're producing content right now, but I consume 10 times as much content as I produce. And most people don't think about that dichotomy. They think it's just dichotomy, one or the other, when it's the spectrum. And I just know the way my personality works is I need to consume voraciously an incredible amount of information.
I think the wisdom of age can be incredibly powerful for short circuiting bad ideas, right? That's hopefully what experience gives you. But I think we would all say that when the environment changes, experience sort of becomes irrelevant. And so the question becomes, when do you run the risk of dismissing something that is fundamentally going to change the landscape? I'm not saying, we're using crypto as sort of the lead in here. I'm not saying crypto is that case, but I think of it as there's a small cost to me from a time and effort perspective to try to continue to explore new ideas. And it's a sort of a bit of an insurance policy to me that I'm, by staying on top of a lot of different things and trying to consume a lot in different areas and seeing what's changing. Maybe I might be feel silly doing it. I might feel a little stupid trading NFTs, but at least now I have the experience and I've been a part of that community, and I can speak from that experience rather than just wholesale dismissing it. I can hopefully make a more educated decision about it. And so I look at it as sort of a hedge to my own inevitable decline, right? That I can't get too comfortable that the regime we're in is going to be the regime I always know.
I would say the same thing, but from a different angle. Is I think part of your age is that like you realize it's almost like ego diminishing, right? Like is you realize to do these things is we're worried about our ego. We don't want to learn new things. Our ego tells us don't learn that, it's stupid. So that way we don't have to learn new things and feel stupid again. Like we want to feel like we're competent. The other part is like you're saying on Twitter when you're talking about NFTs or crypto, the masses of people are going to be like, he's lost his mind from the TradFi world. So once again, it's hurting your ego. But like you've learned through time, it doesn't, you have an internal compass and an internal scorecard, and it doesn't matter externally. And so that's part of like, you just like me, you're feeding that insatiable curiosity and realizing who gives a shit what anybody else thinks of it. It may work, it may not work, but you're just willing to explore, right?
One of the things that came to mind for me, particularly as it relates to my NFT experiences over the last month or two, was a book I read last year called The Secret to Our Success, which I thought was a phenomenal book with a horrible title, but it's all about sort of the ways in which we as human beings have evolved to be the sort of dominant species on Earth. And when we're definitively weaker, we get just as sick as other animals. We don't have sharp fangs. We're not strong. Like we're not necessarily smarter. If you take me and drop me in the middle of the rainforest, I'm probably not going to make it, right? There's no innate knowledge that makes me survive in the North Pole or makes me survive in the rainforest. And yet we have, as a species, been incredibly successful and adaptive. And one of the things it talked about was sort of the cultural knowledge and how we revere our elders, with the exception of that when there is a dramatic change in the environment, and technology is a big one here. When technology accelerates, you find that cultures stop having the same reverence for their elders that they once had, because that knowledge is no longer as relevant. And so that really struck me as I got more involved with different crypto communities, because in some of these discords, I was the oldest by at least a decade. And there was one conversation that took place where one person said that if you're over 30, you might as well just give up in life because you'll never be as fast and creative and smart as you are in your 20s. And so I realized I was the grandfather in that situation, and my wisdom was no longer revered. So it came all too clear for me. I do want to hit a quick pause, Jason, because I want to say, anyone still listening, first of all, thank you. We've been rambling on here for quite some time. But this is a new format, and we're doing it just because in honor of Mike and Ben and that 10 million download milestone that they hit with their podcast, Animal Spirits. But I will say, Jason and I have been trying out all sorts of different formats with Pirates of Finance over the last 9 months. Comment below which ones you like. Do you like the old style that we're more edited and topical? Do you like the new style where we're just more riffing? Do you like it when we stick to a topic? Do you like it when we jump around topics? So don't forget to hit like. Don't forget to subscribe. Tell us what you think. All comments, good and bad. I'm just going to ignore the bad ones.
Last question. Shout out to my boy Travis Kimmel. Posted he always posts his cooking stuff on Twitter. And the other day he made bulgogi cheesesteaks. Thinking about the guys at Alpha Architects and their home base in Philly, is bulgogi cheesesteaks red card, or are you interested?
I'm not from Philadelphia, so I am interested.
My first thought was fire, because I just had bulgogi the other day too, so it was on my mind, and I was like, "This is genius."
Yeah, I mean, I don't have a fight here, so yeah, I would absolutely try it. I don't know if I'd be seen eating it in Philadelphia.
Yeah, my in-laws are gonna hate me now.
But sounds great.
Now make sure you like, subscribe, and hit that notification bell so you never miss one of these amazing episodes.